Alrighty, how's it going, everybody? This is a video that I don't really expect to get too much, uh, like plays or anything like that. I mean, the YouTube channel's small. I like to talk about boring stuff, but I really want to document like my trading journey, the research I do, all that jazz. So, anyways, this is Darius Dale. Um, he owns 42 Macro. Super chill guy. My mentor, I don't know if I should say his name because I've been cursing on the show, so I don't want to embarrass him or anything like that or have like put dishonor on his name or anything like that. But my mentor introduced me to him years ago, and I really like his views on the market. So this is the macro minute. Will the Fed hike rates during an economic downturn like the EM central banks, emerging market? I doubt it, but who knows? I mean, who knows? Let's see what Mr. Darius has to say.
Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, April 17th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the Fed be forced to hike rates during an economic downturn like an emerging markets central bank? Our answers are today, President Donald Trump hosted a great honor to have just met with the Japanese delegation on trade. Big progress with an exclamation point. This highlights his desire to preemptively celebrate a U.S.-Japan trade deal. This is in line with our view that the bond market activated the Trump put last week. Per our April 15th leadoff morning note, yesterday we asked if Trump was losing his own trade war. Thus far, the answer is yes, and the answer may remain yes at the end of the process for all of the fourth-turning polycrisis reasons we detailed in our April 10th leadoff morning note, April 11th leadoff morning note, and April 12th Around the Horn webcast. Elsewhere, Federal Reserve Chair Jay Powell reiterated the Fed's responsibility to ensure tariffs don't trigger persistent inflation, saying the central bank must keep longer-term inflation expectations well anchored and ensure price increases remain temporary. In short, Powell was keen to reiterate his pushback on market expectations for a relatively quick monetary policy response to the slowdown in growth. Moreover, Powell's emphasis that the Fed must make certain that a tariff-driven acceleration in inflation doesn't flatter long-term inflation expectations suggests he is prepared to resist easing for much longer than risk assets and President Trump would prefer. Treasuries gained and stocks sold off following Powell's resolutely hawkish speech. This is consistent with our view that the Fed may be forced to hike rates during this or future growth downturns to attract capital into the Treasury bond market. After all, that is precisely what twin deficit emerging market central banks have always done when foreign investors exhibit nervousness regarding domestic or global imbalances. The geopolitically driven supply-demand imbalance in the Treasury bond market checks both boxes. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding global M2 and risk assets, Bitcoin specifically. It says, hey, Skipper, I've seen people on X sharing the global M2 chart and its lagging but high correlation to Bitcoin price in the last few months. M2 looks to be breaking all-time highs based on the charts shared. Any thoughts on that and how, if any, impacts on Bitcoin price over the next few months? Love your work. Appreciate you. Thank you. Thank you for the question and thank you for the kind compliment. So I have a few things to say about this. Some of them nice, some of them not nice. I'll start with the nice stuff first. The breakdown in the U.S. dollar is a positive influence on global liquidity. Certainly on a long enough time horizon. When we analyze global liquidity, the dollar's correlation between global liquidity tends to be as tight in the kind of the 3 to 6 month window as a persistent leading indicator of global liquidity. As we cautioned our clients in early March, however, is that the initial breakdown in the dollar was likely to be capital outflows from U.S. assets, and that's exactly what we saw in March and April. So we were obviously correct on that. So folks who were calling for the dollar to break down and to support global liquidity and risk assets got that part of the trade wrong. They were on the wrong side of the crash. We were not. The not so nice part of this conversation has a lot less to do with where markets and the economy are headed and just general blocking and tackling as it relates to performing institutional grade analysis. I saw a chart the other day. It was like a daily chart of global money supply, and then and I couldn't for the life of me figure out how someone constructed that chart. For example, let me take you to my Bloomberg terminal here. The four largest economies that contribute to global money supply don't publish daily data. In fact, the US is the only one of those major economies that publishes weekly data, and the most weekly data point is from March 3rd. The most recent aggregate data point is from February for the US. It's from February in the Eurozone. It's from March in China, and it's from March in Japan. So again, going back to the question, I can't for the life of me figure out how in the world anyone has a daily or weekly chart of global liquidity with April time series data. To me, it's misleading. It's just flat out misleading. There's no other way around it. What the chart is obviously picking up on and being misinterpreted as is the fluctuations in the currency market. They're applying the daily or weekly fluctuations in the currency market to monthly time series that don't have data reported for the period in question. And that, in my opinion, is a no-no as it relates to institutional analysis. I've done probably upwards of 6,000 meetings throughout the course of my 16-year career on Global Wall Street with institutional investors around the world, and many of the best hedge funds and insurance funds and mutual funds and pension funds and family offices around the world. And not once have we talked about liquidity on a weekly or monthly frequency, because I think everyone in those rooms understands that that's not possible. What else will I say? Another chart kind of crime I see out there on the Twitter sphere is this sort of, this sort of lack of time series history when people are making charts, right? The whole purpose of putting a chart together is ostensibly to understand how the cycles behave, right? How the variables relate to each other across economic and financial market cycles. And so I see a lot of charts that have very limited time series to display a correlation, whether it's leading or lagging between multiple variables on a very short-term time horizon. And that to me is a very clear and obvious indication of overfitting in an analysis. And those models almost always break down, not only when you pull the charts back to add more time series history in terms of the business cycles and market cycles, but they obviously will break down in the future because they were overfit as well. And so, as you know, when you see charts from us, you see a tremendous amount of time series history. We don't overfit. We don't do this thing leads that, and no, here's that. Now let me draw an arrow up or down because this thing leads that. I see a lot of that out there as well. You don't see a lot of that in institutional meetings. Again, it's not to be pejorative, but I'm just saying there is a difference between what we do here at 42 Macro and what I see out there on Twitter. And again, I'm not trying to be disparaging to anyone. Everyone's got to make a buck. And quite frankly, to me, at the end of the day, what matters is the results that, people's clients feel in their portfolio. So to me, I'll always defer to that. But just in terms of like protecting your eyes and emotions and your portfolio from what I would consider to be chart crimes and what most institutional investors would consider to be chart crimes, you're going to want to start to look for these types of things. Is there enough time series history that spans multiple economic and market cycles? I'm talking decades. Is this chart overfit? Are you using multiple axes to sort of spot correlate to convey correlation? Are you conveying correlation on raw time series data with without normalized values? That's another thing I see all the time out there that doesn't make any sense from the perspective of institutional grade research and analysis. There's a lot of chart crimes out there, but this one about liquidity is something I definitely wanted to shine a big flashlight on, because to me, I feel like this concept of liquidity is a very squishy and amorphous concept. I probably say the first 5-10 years of my career, we thought about it, but it wasn't this big overall arching dynamic. I would say post COVID, particularly once we got a lot of retail investors very keenly focused on the macro, this concept of liquidity is really ballooned, because I think we've seen a tremendous amount of liquidity, both from central banks and finance ministries around the world. But we've also seen a lot of participation in asset markets from retail investors, particularly retail investors exposed to the crypto market, of which liquidity is a big driver of. And so, I think it's an easy way for people who do what I do for a living to connect with the audience. It's just, start tweeting about liquidity, tell people the things that they want to hear, which is Liquidity's all around. It's right around the corner. You got to buy Bitcoin. Liquidity's right around the corner. You got to buy Solana. Liquidity's right around the corner. You got to buy Ethereum. And I see a lot of.
Uh, I know I haven't said too much in this video. That's because I'm just processing information, and this for me is more of a learning process of just absorbing the information, taking it in, and thinking how I would use it. But I do want to say that I've always found it interesting that you have like perma bears, people who are like the crash is right around the corner, and then you have perma bulls. I don't even know if the terminology would be perma bulls, but you just have people who are super bullish. And like he said, you have like what he just mentioned, you have people saying liquidity is right around the corner, buy Bitcoin, buy Solana. And you also have the bears who are just like, the crash is coming. Oh, like for instance, the video I made last with Ray Dalio, and the interviewer trying to get him to say that, yeah, we're going to go into a depression. And it's just like people want those headlines, or people want other investors or other traders to, back their play. And they have such conviction that the market is going to go higher, or so much conviction that the market's going to go lower, that they're blinded by everything else, like by the macro, by the information that they see. If it doesn't align with their viewpoint on the marketplace, they kind of become like completely like drawn away from anybody else who has a different opinion. And they'll be like, oh, these idiots, or like, these people are so beneath me type thing, like on a high horse. And I just find it interesting, like the psychology behind that, because of the fact that people on both sides can make money. Don't get me wrong. But, in my opinion, I want asset prices. I want risk asset prices to go up, because then trading and investing is so much easier when you have liquidity, or you have like a Goldilocks market regime or inflationary market regime, and everything's just so easy. I won't say super easy, but it's still, it still have to have some type of edge, but it's a lot easier to make money because assets just go up. But when you're in these markets like now, it's very difficult to trade because the volatility is through the roof. But I just think it's interesting how like you always have this dynamic between bulls and bears, or like, people just trying to throw their narrative around instead of just looking at what the data is and then being non-biased. And of course you want to have some type of bias, because for me to go long, I need to have a long bias, or for me to go short, I have to have some type of short bias. For me to even click the button to place a trade, I'm not gonna sell the market if I think it's gonna go up, or I'm neutral. You know what I mean? Anyways, I just think it's interesting how that narrative gets pushed. I want that there would be liquidity, though. I really would hope, though. But it's interesting also because even though I've been in macro for a few years now, I'm still so new, and there's still so much that I need to learn. And I wouldn't have known about the liquidity. Like if I saw that M2 chart, I probably would have just like, oh, that's it. Like, oh, that looks legit. You know what I'm saying? Like, so I don't want this video to come across like or this whole channel, I don't want it to come across like I'm some genius, macro guy. Like I'm just a trader, and I've just been grateful enough to be pointed in a direct direction by my mentor to look at the people who actually know what they're talking about from a macro perspective. And I still have to take what they say with a grain of salt. You know what I mean? But I just have so much respect for him in general. Like even Ray Dalio, like I have so much respect for Ray Dalio. And like in that video I mentioned, I think he's spot on. But just Wall Street, or like, I guess like Wall Street media just wants to push these two narratives that it's either the end or that we're going to reach all-time highs. And in my opinion, right now with the market looking at it, I feel like it's going to be sideways for a few months. Maybe, I think Trump put 90 days on, so maybe we have 2.5 months left of just chop. You know what I mean? Until there's actually a definite decision on what's going to happen with tariffs.
Of that out there, and it's not to say that it's right or wrong. I'm just saying.
Oh, and let me say, I could be completely wrong on that. You know, you have to trade what you see on the chart, or what new numbers come out, or what new information comes out. But this is like, in my opinion, with macro, you're kind of just like forecasting what could potentially happen. You're not trying to say this is definitely going to happen. So yeah.
That as a in retail investor, if you're listening to me, the institutional investor talk, representing the discussions that I'm having with institutional investors around the world, this is not the stuff we see or do or talk about. So, you guys can continue doing what it is that you're doing, and I have no problem with you doing what it is that you're doing with your own money. But just know that there's a lot of chart crimes out there being committed, especially in the context of liquidity. Again, there's no weekly or monthly time series that will allow you to ascertain liquidity. Major countries in the world and their central banks don't publish time series for you to even build liquidity models with on the frequency that I see a lot of liquidity models out there. So just be aware of that stuff. So hopefully that was helpful. Again, like I said, I'm not saying this to be pejorative or disparage anybody in particular or anybody at all. I'm just trying to help you, the retail investor, be smarter about these dynamics so that you don't get, the rug yanked from under you heading into a crash because you're concerned about, somebody's 3-day or 3-week, liquidity chart breaking out. So just be aware of that. Just trying to help. So we'll wrap it up there. Darius Dale here presenting our macro minute for Thursday, April 17th, 2025. Best of luck out there. We'll catch you back here on Monday. Obviously, we got Good Friday and the Easter holiday this weekend. So shout out to everybody that celebrates. Cheers.
Man, I have so much respect for Mr. Darius. Especially for just sharing macro information. I mean, like, a lot of this stuff could just be information he just kept for his clients. Didn't need to make a YouTube video about anything. Or just share the information on like the chart crimes. I had no idea about that. I didn't even see the M2 chart they were talking about for liquidity. But yeah. Let's talk about this. Future Eon, have you gotten better at your macro analysis? And then also, the day is, let's see, April 17th, 2025. Let's say two months from now, I would like for you to look at the chart and see what played out. Did the market chop like you thought it would? Or was liquidity just completely wiped out and we end up having a crash? Or is liquidity provided and then, we end up making all-time highs, So yeah, I mean, and for family and friends who watch this video or just random people, I appreciate you sharing this knowledgeable little video with me, and I hope you were able to learn something as I was able to learn something as well. And yeah, love you guys. Peace.
Man, even Jesus had a shooter, and God be having unbelievers that didn't mess up their demeanor. And yes, they know it's hard, they know, cause when they be up in those trenches, man, they show, but what they do